Hello everyone. All right, so welcome back. All right, so I hope that so far in this series you have gained some real important knowledge. You have actually understood how things work, and basically I was able to really add value to you. Now today we're going to talk about a ratio that is slightly more advanced. Okay, usually amateur investors or beginner investors, they will not use this ratio, but I think that personally it has served me quite well, right? And I wanted it to serve you as well, right? If it can serve you, then I would have served you. So I want that to happen, and therefore I'm gonna still introduce you to this ratio. Now if after this video you still do not quite understand how this ratio works, there's one of two things that you can do. Number one, you can watch this video again. Number two, you can do a bit more research. All right, or number three, you can email me. All right, you can email me. You can email me or leave a message on our Facebook page, and I will get my team to actually answer your queries and guide you along as best as we can. All right, so without further ado, today we're going to talk about the PEG ratio. Okay, we're going to talk about the PEG ratio, PEG ratio. Right now, without the G, you already know what that is, right? In one of the previous videos, it's price to earnings, right? So with the G, what does the G stand for? What does the G stand for, right? The G stands for growth. So price to earnings to growth ratio. All right, I repeat, price to earnings to growth. Okay, so how is this ratio calculated? How do you put three variables into the same ratio? Okay, now the way this is done is simply, all right, by taking your price to earnings ratio, all right, divided by your earnings, expected earnings growth. Okay, for X number of years. Usually we project ahead for the next year. All right, so earnings per share growth. All right, because this is price per share, this is earnings per share, so this should be earnings per share growth. All right, but in any case, whether it's earnings per share or earnings growth, it doesn't matter, because this is denoted in terms of a percentage. So your per share earnings growth and your overall earnings growth percent will be the same. Oh my god, okay, tablet is dying. All right, will be the same. So now, what is this ratio good for? It's good for three things. All right, it's good for three things. Number one, it enhances your price to earnings ratio. All right, it further enhances. How does it enhance that ratio? It enhances this ratio by adding in expected earnings growth. So instead of just price per share divided by earnings per share, now you are able to project forward. So price to earnings ratio is a ratio that is taking into current figures or previous figures, but with the PEG ratio, you are taking into account future figures as well, forecasted figures. Of course, if it's a forecasted figure, it could be wrong, and of course we all know that forecasted figures are partially built on hype, meaning it's built on expectations instead of reality. Okay, so of course there will be a certain degree of inaccuracy, but if the degree of inaccuracy is not great, it will still allow you to really project into the future. And most of the time, for me, the inaccuracy is digestible. It is not absolutely off, all right, unless there's a huge major global event that's happening or happens. All right, if a major global event happened like the COVID-19, then yes, your PEG ratio for aviation, for example, back in 2019, N2019, projecting into the first quarter of 2020, will be way off, right? Because nobody expected this virus thing to completely cripple the aviation industry. All right. Now, second, the PEG ratio can be considered to be a true reflection of true value of a stock. All right, true value of a stock. Okay, and usually a lower PEG ratio is better, because similarly to a lower PE ratio, it basically means that the current stock price is still considered undervalued. So it means that there is still room for growth. But I already explained in the PE ratio episode why you cannot look at things in such a simplistic manner. You have to look at the industry as well. So I'm not going to repeat. I'm not going to repeat that explanation here. If you want to hear that explanation, please go back to the price to earnings ratio video. Okay. The third positive thing about the third advantage about the PEG ratio is that the PEG ratio, okay, can differ significantly from one reported source to another. Now, this is not really an advantage, but more of a characteristic which you need to know. Okay, it can differ from one source to another because, like I said, the earnings growth figure, the denominator is a figure that is calculated based on projections. So every company uses different statistics to do projections, especially if you are in an industry whereby you have so many statistics to choose from in order to do your projections. Sometimes you're just painting your own story. Alright, not sometimes, you are painting your own story. So every source uses a set of different statistics to project into the future, to project revenue for the future. There is no way of telling which source has the right set of figures or which source will provide the figure that is going to stick closest to the actual figure that comes out. Alright, so this is, you can consider it a slight disadvantage of the PEG ratio, but so far it's been working very well for me. Alright, so whether it's the PEG ratio or the PE ratio, these are all things that you can Google, right? As long as it's a listed company, usually the PEG ratio will be given to you. Alright, so for example, if I go to Google right now, give me a moment. If I go to Google right now, okay, and I type right here, right, PEG ratio of Facebook. Right, so let it load. Okay, so you can see right now it's 1.8. So usually the lower the better, right? You can see that Facebook's PEG ratio, it says right there, Facebook's PEG ratio of 1.8 is lower than the industry average, which is 2.21, which is good. Okay, which is good. Internet services industry. So I believe this is the equivalent of software as a service. Now, here's the thing that I want to remind all of you. All these terms, software as a service, F&B, now certain terms are carried over to all markets. But certain terms can change, especially between UK and the United States. So certain terms like software as a service, I believe that's exclusively for the United States. Maybe for the UK, it's called internet to services industry. Alright, Zex.com, I mean, you guys can go and check the IP address. It could be a UK website. So that's why they're using a UK term. Now, it is important to know all these terms because Wall Street is the grand inventor of complex terms. So you need to understand the different terms and how they convert in different markets. What kind of different words they convert to in different markets. We all need to know that. Okay, so this is an example for you. Alright, so like I said and as I displayed, it's incredibly easy to find the ratio right on Google. So there's no need for you to calculate. But because you're a beginner, it is good. It is very good if you at least know what figure you're looking at and what significance it has, so that it is not just a figure to you. At the same time, it is knowledge to you, and at the same time, you can use that knowledge to extrapolate data for unlisted companies. Now, like I said, all this data is only available for listed companies. So if you're asked to invest into an unlisted company, okay, these data figures will not be there for you because nobody has done the calculations for them. Right? So you need to calculate it yourself. So this is where your own knowledge comes into play. Okay, so thank you very much. My name is Jefford. Like and subscribe to this series of videos. Like and subscribe to me if you want more videos like this. Of course, we do many different kinds of videos. The signature series for this channel is the Power Giver series. So if you are a trainer, you are a coach, you are doubting, you are hesitating whether you have the ability to train or teach, you should watch that series. I will take away all your doubts. I'll give you some useful tips, some skills for you as well. Okay, and the reason I can do that is because I am the co-founder of the Rubik's app, whereby we match education vendors to learners. So I have seen coaches and trainers come and go. Now the reason why I'm also doing this Stocks Beginner series is because my own background as a trainer, because I'm a trainer as well, my own background is in stocks and technology, and for technology it's particularly with reference to blockchain. Alright, so that's why I'm doing this as well. Alright, thank you very much. I hope I've added value to your knowledge base, and I hope to see you in the next video. Thank you.